Have you ever wondered how a mere 25 basis point cut by the Federal Reserve could alter the landscape of commercial real estate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. After months of speculation and anticipation, the Federal Reserve finally cut the federal funds rate by 25 basis points to a range of 4.00 to 4.25%. This marks the central bank's first rate reduction since December 2024, ending nearly 2 years of aggressive monetary tightening. Stephen Suburban reports that Fed Chair Jerome Powell described the decision as risk management, highlighting concerns about a softening labor market, even as inflation remains above the Fed's 2% target. With unemployment climbing to 4.3% in August and job growth showing signs of deceleration, the central bank seems to be shifting its focus from fighting inflation to supporting employment. This pivot could reshape the commercial real estate landscape for the remainder of 2025. For commercial real estate investors who have been dealing with high borrowing costs, this rate cut delivers immediate financial relief. Rate decreases impact multifamily and commercial real estate by increasing liquidity across the financial system, improving cash flow coverage as loan loss reserves for banks decrease. Consider a typical scenario. A $50 million office building with 70% leverage could see annual debt service payments drop by $350,000 to $500,000. That's real money flowing directly to the bottom line, improving debt service coverage ratios and providing property owners with much-needed breathing room. This relief comes at a crucial time, as approximately $1.2 trillion in commercial mortgages are set to mature over the next 2 years. A refinancing wave that had many investors nervous about securing favorable terms. Not all commercial real estate sectors will benefit equally from this monetary policy shift. The multifamily market appears positioned for the biggest gains, with reduced financing costs potentially spurring new development projects and boosting profitability for existing properties. Experts anticipate increased property listings and buyer activity through the end of the year and into 2025. Especially if the Fed drops rates another 0.5% by December and up to a full percent in 2025. Industrial real estate, already benefiting from e-commerce growth and supply chain reshoring trends, may see further acceleration as developers find financing new projects more attractive in supply-constrained markets. Grocery-anchored retail centers could also experience a renaissance as lower borrowing costs coincide with increased consumer spending power. The office sector presents a more complex picture. While cheaper financing provides some relief, fundamental challenges remain. Remote work has permanently altered demand patterns, and many urban markets continue grappling with elevated vacancy rates. However, savvy investors may find opportunities in high-quality assets trading at significant discounts to pre-pandemic values. Moreover, lower rates may provide borrowers with more favorable opportunities to refinance existing fixed rates or floating debt at a lower cost. Beyond financing benefits, the rate cut could help address one of the commercial real estate market's most persistent challenges: the wide gap between what sellers want and what buyers are willing to pay. Cap rates are expected to compress by 50 to 100 basis points for stable, income-generating properties. This compression, combined with improved financing conditions, should help narrow bid-ask spreads that have kept many deals on the sidelines. Transaction volume, which has been anemic compared to historical averages, may finally start picking up as sellers become more realistic about pricing and buyers regain confidence in their ability to secure attractive financing. The Fed's updated projections suggest additional rate cuts could be coming before year-end, with some committee members advocating for more aggressive easing. While a single rate cut may not cause a significant additional drop in mortgage rates, a series of anticipated cuts for the rest of the year could have a more substantial impact. However, commercial real estate investors should not become too comfortable. The Fed's decision to cut rates also signals concerns about economic growth, which could impact tenant demand and rental income down the line. Construction costs remain elevated due to persistent inflation in materials and labor, potentially eroding the benefits of cheaper financing. Regional banks, which hold significant commercial real estate exposure, may remain cautious in their lending practices despite lower rates. The recent banking sector stress has made many institutions more selective about commercial real estate deals, particularly in sectors like office that face structural headwinds. Smart commercial real estate investors will view this rate cut as an opportunity to reassess their portfolios and positioning. Properties with strong fundamentals in supply-constrained markets may see the most benefit from improving financing conditions. Development projects that were put on hold due to high borrowing costs may become viable again. The key will be staying focused on quality fundamentals rather than getting swept up in rate-driven euphoria. Location, tenant quality, lease terms, and market dynamics still matter more than financing costs in determining long-term investment success. As we move through the final months of 2025, the commercial real estate sector finds itself at an inflection point. The Fed's rate cut provides a foundation for recovery, but success will ultimately depend on how quickly the broader economy adapts to this new monetary environment and whether investors can navigate the opportunities and pitfalls that lie ahead. San Francisco's commercial real estate market has recently experienced a surprising development. For the first time since the onset of the pandemic, one of the city's most iconic office towers is up for sale. The 48-story skyscraper located at 101 California Street, known for its bold cylindrical design and full-block footprint, is now on the market. This tower, which houses a mix of high-profile tenants like Goldman Sachs, Morgan Stanley, and Chime, represents a rare opportunity in the city's real estate market. A significant ground floor renovation, costing approximately $75 million, was completed a few years ago. This renovation included updates to the tower's outdoor plaza and lobbies and the addition of hospitality-style amenities, all intended to maintain its allure. While marquee properties in San Francisco, such as 101 California, the Ferry Building, and One Maritime Plaza, seldom hit the market, the sale of 101 California is seen as a milestone. The real estate investment bank Eastdil Secured is discreetly handling the sale on behalf of the ownership. Sources indicate that the asking price is about $900 per square foot, totaling just over $1 billion. This price reflects a decrease from its pre-pandemic valuation of over $1,000 per square foot. The news of this listing has prompted discussions among real estate insiders, who are trying to discern the motivations behind the sale amid positive developments in the market. Some speculate that the sale might be a strategic move rather than a reflection of the city's real estate market conditions. There is an ongoing debate about whether San Francisco's trophy properties are now vulnerable to market stresses. The asking price, viewed as a billion-dollar point with a $750 million loan, suggests that investors are drawn to high-leverage, low-interest loan deals that can be strategically refinanced as interest rates decrease. The ownership structure of 101 California is complex, with Hines having developed the building and managing it while holding a minority interest. The majority ownership lies with GIC, Singapore's sovereign wealth fund, with the Hong Kong Monetary Authority also holding a stake. The potential sale of 101 California could serve as a litmus test for the current valuation of San Francisco's most desirable office buildings, providing insight into the city's high-end real estate market. In comparison, San Francisco's office market has been challenged by high vacancy rates and reduced prices, with some properties selling at a fraction of their previous values. However, the city's trophy buildings, totaling about 8.3 million square feet, have maintained strong rents and occupancy levels. According to CBRE, these buildings have a combined vacancy rate of 16.1%, significantly lower than the overall office market's 34.6% vacancy rate. Average asking rents for trophy buildings have risen to $115 per square foot, approximately 7% higher than pre-pandemic levels compared to a 22% decrease in market-wide rents. This highlights the resilience and continued demand for high-end office space in San Francisco, even as the broader market faces challenges. The potential sale of 101 California is seen by some as a positive indicator, suggesting confidence in achieving high pricing in the current market environment. The situation with 101 California also reflects broader market dynamics, where foreign government-owned entities like GIC are actively refining and diversifying their investment strategies. GIC's decision to sell could be part of a broader portfolio management and rebalancing effort. The outcome of this potential sale will not only provide clarity on the value of San Francisco's trophy buildings, but could also signal a renewed appetite among institutional investors for the city's high-end real estate. In the first half of 2025, the commercial real estate market in Northwest Arkansas experienced an increase in vacancy rates across all sectors, as reported in the latest Skyline report, sponsored by Arvest Bank. The report, conducted by the Center for Business and Economic Research at the University of Arkansas's Walton College of Business, showed a net negative absorption of 648,360 square feet, resulting in an overall vacancy rate of 7.2%, up from 5.8% in the second half of 2024. The office segment saw a vacancy rate increase to 6.8%, up from 6.3% in the latter half of 2024, although it was lower than the 7.5% recorded in the first half of 2024. Retail vacancies rose to 6.6%, compared to 4.9% in the second half of 2024, and 6.2% in the first half of 2024. The warehouse sector experienced the largest jump, with vacancy rates climbing from 7.6% to 10.4%. This fluctuation is attributed to the segment's size, where even moderate net negative absorption can lead to significant swings. Despite the increase in vacancy rates, the commercial real estate market in Northwest Arkansas is described as remarkably healthy. According to Mervyn Jebaraj, director of the Center for Business and Economic Research, low vacancy rates are generally seen as positive, but in a dynamic market like Northwest Arkansas, very low vacancy rates can pose challenges due to limited availability. The report also highlighted strong building permits that were well dispersed geographically and by sector, indicating a healthy market. In the first half of 2025, Northwest Arkansas issued $290.2 million in building permits, with $276 million going to projects unrelated to the new home office for Walmart Inc. in Bentonville. Non-Walmart construction permits totaled $190.3 million in the second half of 2024. While the expansive Walmart headquarters project has dominated building permit statistics in recent years, it is beginning to subside as construction nears completion. Only $14.2 million in permits went to Walmart in the first half of 2025. Since the first half of 2023, only 1.7% of the $1.18 billion in commercial construction permits were for Walmart, compared to 53.2% of the $1.77 billion in permits from the first half of 2021 through the first half of 2023. This shift indicates a diversification in construction projects in the area, contributing to the robust health of the commercial real estate market. The shopping center located at a signalized intersection on Old Milton Parkway, right at the entrance to the Woodhaven at Park Bridge apartment community, has recently been sold for nearly $13 million. This transaction highlights the ongoing demand for unanchored shopping centers in Atlanta's suburban areas, reflecting a robust interest in retail spaces that do not rely on a single large tenant to draw traffic. According to Henry Queen from the Atlanta Business Chronicle, the sale of this site is indicative of a broader trend in the region, where commercial real estate investors are actively seeking opportunities in suburban markets. These areas offer strategic advantages such as lower acquisition costs and the potential for higher returns, particularly as urban centers continue to face challenges like elevated vacancy rates and changing consumer behaviors. In a cross-border comparison, similar trends can be observed in regions like Kitchener-Waterloo and Cambridge in Ontario, Canada. These areas have seen a steady interest in multifamily and retail developments, driven by a growing population and a strong local economy. Investors in these Canadian markets are also capitalizing on the demand for residential and commercial spaces that cater to a diverse tenant base. The Alpharetta transaction underscores the importance of location and community integration in commercial real estate investments. Properties situated in well-trafficked areas with access to residential communities tend to perform well as they offer convenience and accessibility to both tenants and consumers. As we continue to see these market dynamics unfold, it's clear that strategic positioning and understanding local market nuances are key to successful investments. In a significant development for Raleigh's commercial real estate landscape, a new funding bill has been passed by state lawmakers, allocating substantial dollars for the development around the Lenovo Center. This move is seen as a game changer for the region, potentially boosting economic growth and attracting further investments. The Lenovo Center, which has been a focal point for business and technology in Raleigh, is set to benefit from this influx of capital. The development is expected to include new commercial spaces, residential areas, and community amenities, enhancing the area's appeal to both businesses and residents. According to David Pertel from the Triangle Business Journal, this initiative is part of a broader strategy to strengthen Raleigh's position as a leading hub for innovation and commerce. With the support of the funding bill, the development around the Lenovo Center is poised to become a vibrant and dynamic part of the city. This project aligns with similar trends observed in other regions, where investment in infrastructure and community development has spurred growth in the commercial real estate sector. In Canada, cities like Kitchener-Waterloo and Cambridge have also seen significant investments in their technology and business hubs, driving demand for commercial and residential properties. As we continue to monitor these developments, it's clear that strategic investments in infrastructure and community projects can have a profound impact on local economies. The Lenovo Center's expansion is expected to not only create new opportunities for businesses, but also enhance the quality of life for residents in the area. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.